This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Nick Maclean, thanks very much for coming back on Talk Your Book. You're a repeat guest. Before we get into your stock pick, I thought if you could start with Surrey Asset Management and a bit of an update on what you guys do and how you guys look to invest.
Yeah, thanks, Chris. Firstly, it's great to be back. It's my third time and Surrey's fourth time back on Talk Your Book, so hopefully we're doing something right. For your viewers who might not recall, Surrey is a long-only small-cap ASX listed focused fund. Performance to date, we're 4 years on in terms of track record. Performance to date has been solid. We're very much focused on risk-adjusted returns as opposed to the real razzle-dazzle, huge ups and downs. But we've been outperforming solidly since inception per annum, which is very pleasing for us.
And what stock did you want to talk about today?
Today, I thought I'd talk about one that's a little more topical for your audience, and that's Domain Holdings. The reason I say it's more topical is, one, it is property related, which is in the news, every day, obviously, and secondly, it is a technology-focused stock, which is also in the sector, which is very much in the news with the US 10-year bond yield rising and what that's doing to valuations, particularly of those tech-based names. So that's the one we're talking about today.
And there's a little bit more to it than just the Domain website, isn't there? Maybe talk us through the helicopter view of the business and a little bit about the different divisions that they've now got.
Yeah, so everybody knows Domain as, or most people will know Domain as that as the domain.com website, which has got your listings. It's the number 2 player to realestate.com. Realestate.com's revenues are about 2.5 odd times larger than Domain's.
Is it gaining ground on REA, or is the difference sort of...
No, so it depends what metric you actually look at as to whether it's gaining ground on REA. REA says it's not, Domain says it is, but really I look at the revenue, and that's probably the best way to look at it. Listings come and go, and it's also quite regional. So Domain are more dominant in Sydney, REA are more dominant in Melbourne, and then there's region by region. So it can vary quite a bit. The main metric I look at is revenue in terms of market share, and REA is keeping a pretty solid lead there. That's not to say there's not room for a very strong number 2 player, which is what Domain is. But to come back to your point, the main listings business is 70% of its revenue, which is what everybody knows. But then there are another few parts to the business which it's building out. One is the media business, or I call it the media business, which encapsulates its banner advertising, developer advertising, and commercial property in there. So that is 15% of revenue. Then you also have agent and consumer services divisions, which we'll get into. That captures 9% of revenue, and then the remaining 6% of revenue comes from the traditional legacy print business that it's had for quite a while, and that's shrinking, as you can imagine, as a percentage of the total pool. But residential listings is still the absolute key to the game for them.
And it's been really good top line growth looking through their most recent presentation, but Agent Solutions, while still a small part of the business, I think it was growing over 60% on an annualized basis. Is that something you think is going to grow into a real material division for them?
So I do. You have to be a little careful that they do have acquisition in there, but it is still growing at solid double-digit rates. The purpose of Agent Solutions, and the best way to think about it is trying to more ingratiate themselves in with the actual with the agent themselves. So it brings in a platform where the agent, so for example, Chris Judd, real estate agent, can manage the entire listing process from start to finish. So the entire marketing process from start to finish. So the advertising, the open for inspections, tracking who's come in and who hasn't. And that's quite important to agents, and that's got around about a 40% market share nationwide. The purpose of that is, one, obviously to generate revenue and earnings, but two, to further entrench themselves into the agent so they become more and more necessary to that client. So I do expect that to grow, but like I mentioned, it's got two purposes: one, to support the listings business, part of the business, and then two, obviously to grow in its own right in terms of revenue and earnings.
And can you see home loans, or can you see any of the other divisions growing to be material contributors, or it's really the agents?
Yeah. So then you've got consumer solutions, which is not new, but it's only 3% of revenue for these guys, and that's, like you mentioned, the home loan broking. They don't write home loans themselves; they effectively broke them. It is only 3% now, but I think we've seen the importance of it to these portals with realestate.com buying mortgage choice, which we saw whenever it was a few odd months ago. Will Domain go down that path? I don't think so in the short term in terms of a big bang acquisition, but it is again about capturing both these platforms. REA and Domain are about capturing the entirety of the real estate transaction, from the time you start thinking about selling your house to the time you've actually sold your house, and then beyond, through to things like moving, finding removalists, so on. So if we talk about what's the addressable market, the revenues of these two combined are about $1.5 billion at the moment. So call it about a $2 billion market at the moment, as it stands right now. But we see the market being a lot bigger than that, both in terms of revenue growth in listings, so the core business, but then also as these guys expand out into things such as mortgage broking, like you mentioned, the agent services, like we just spoke about. So the addressable market is far bigger, and it's growing at double-digit rates, which we obviously get very excited about.
They don't always want to do it, but there is that sort of earnings multiple arbitrage that high valuation tech stocks can get from buying more mature business like mortgage brokers, where the multiples are just going to be much lower, aren't they? Particularly if they get to script.
Yeah, that's right. So Domain hasn't done that. Domain's done the reverse and bought businesses. It issued some script to buy business not too long ago. The businesses it's bought have been probably more strategic than just for earnings. Not to say realestate.com's purchase wasn't strategic, but it also, like you said, had that multiple arbitrage advantage as well, given the lower multiple that it was acquiring.
And so talk me through the US 10-year bond yield. You mentioned at the start how as 10-year bond yields rise, the valuation of tech stocks get crunched. How are you viewing that arm wrestle the market's currently having in bonds, where you've got highly, a lot of inflationary pressures, and you've also got recessionary fears. And obviously recessionary fears in recent history have meant bond yields are going to get crunched. Inflationary pressures mean that bond yields are going to rise. How are you marrying off the arm wrestle that we're seeing in bond markets at the minute? Yeah,
so if we had spoken about it a month ago, bond yields have dropped to 100 odd basis points down to sort of call it 2.5, and they've since recovered now to be just a little bit over 3%. That US 10-year bond yield. Our view at Surrey is a little different to what's out there in terms of the market. We don't think we're going to see yields expand dramatically up towards that 5, 6, 7% in a short period of time. We do think they will settle at around that 3, maybe 4% mark. And our rationale behind that is, I think a lot of the inflation, which you just mentioned, that we're seeing, is supply driven more so than actual demand driven. And I'll be very simplistic about this, but obviously often that's the best way to be when it comes to economics. When you walk through the supermarket now, or you listen to the Coles supermarket's earnings call the other day, people are starting to shop down. So the higher priced, more expensive items, that whatever it might be, an eye fillet, instead of buying the eye fillet for $28, you might be buying the lower grade steak for $20, or the branded bread, you're buying the no branded bread. we're seeing that more and more. The more people we speak to, the more I hear it back. And as I mentioned, Coles talked about it on the call. So that's obviously just one example, but I think inflation will come back fairly, not rapidly, but over the next 6 months. The sort of figures we're seeing now are not sustainable. And like I mentioned, I think they are supply-driven, not demand-driven. As China opens up post-COVID, as all our supply chains start reopening, or not reopening, but more fully opening, people get back to work in these distribution networks, I think you'll see inflation come down and interest rates start to steady. What does that mean for companies like Domain? We're bottom-up investors first and foremost, but with very much a macro awareness of what's going on. If I look at the bond yield now, at the US 10-year bond yield now at we'll call it 3%, I can buy that at 3%. It's not growing. I get my 3% effectively risk-free, or I can buy a Domain. And the way I look at Domain is if you inverse if you give it its earnings yield, pre-tax earnings yield, it's comfortably over 5%. So I'm buying a business that's on a pre-tax earnings yield north of 5%, that's growing on my numbers over the next 3 years at 20% per annum. And it's a very good business run by a very, very solid management team with a great balance sheet. I prefer that any day over a static 3% yield.
So would I. Talk to me about housing turnover versus house prices. I think a lot of people view the local driver, if you like, of a business like this being house prices, but in fact, it's turnover of houses, I suspect, that drives it more. Is that how you view it, and is that a misconception in the market?
Yeah, spot on. So house prices, people see 20% correction in house prices or whatever hysteria the media puts out, and they think that's bad for Domain. It's all about volume for Domain. So price is important only in the context of what it does to volumes.
Which they can drop when house prices get crunched. Fewer people. So there is a correlation, is that?
Yeah, there is, but it's not a dramatic 20% drop in house prices, 20% drop in volumes. It's just not that closely correlated, but I accept that there is definitely a correlation. Something to be very aware of, and we've seen through previous cycles, not that Australia has really, over the last at least 10 years, gone through a negative housing cycle, but what we do see when times get tougher, people require more cut through of their house because time on market is longer. People are more picky, so they pay up, I should say, for better priced advertising through Domain. So Domain might have a slightly lower number of properties on its site, but that slightly lower number will be taking up higher priced products to get the better cut through. So a bad market in terms of volumes isn't necessarily directly a bad thing for revenues. Then that brings me on to my next point, which is a point of differentiation between Surrey and the market. The market is currently expecting a decline in property volumes of, call it 5%, or around that mid-single digit level for the next 12 months. I disagree with that. I think we've seen July and August volumes up around the mid-teens level, which is obviously very, very strong. As we come into September, which is a key selling period, October and onwards, I don't think we're going to see any significant drop-off in terms of negativity. And my rationale for that, and where I'm a little bit different to the market, is we did have a big bounce sort of this time last year as we came out of COVID, and we saw a big spike in properties coming on market. But remember, COVID was catastrophic for actual listing volumes. So they were coming off a very low base. And I think that a re-emergence of properties on market will actually take time. I think that will play out over the next 6 months as people start to bring their properties on. I don't think it's a quick bang 2 month spike and then that's it. I think it will go on a little longer than that. And you're based in Victoria. I'm based in Victoria. We, as you know, we were in stop-start, shutdown. So did anyone really want to put their house onto the market, even when we come out of lockdown, if the threat was there that in 3 weeks we're back into lockdown and nobody can do a walkthrough of your property? So I think that the volumes will be a lot better than the market thinks. And then we're cycling the federal election as well in the second half of this financial year. So I'm looking at flat volumes, maybe even up, which is different to what the market is saying.
You touched on their numbers earlier, their growth numbers being strong. Maybe just give us the view of what their PE is, what their revenue growth is, and maybe a little bit about how their balance sheet's looking.
Yeah, so the PE currently on my numbers for full year 23 is trading on about 27.5 times, which, like you know, is obviously not cheap. I've got earnings per share growth just north of 20%, and I've got that continuing per annum for the next 3 years through issues we spoke about with regard to price rises, increased depth take up, so improvement in yield, and then the ancillary products growing as well. In terms of their margins, these guys have got a lot of flex. They've called out a 36.5% EBITDA margin target for full year 23. They can flex that quite a bit. So if I'm wrong on volumes and volumes drop 8%, these guys can pull back on marketing to adjust for that to keep the margins quite steady. So I'm comfortable there. And then on the balance sheet, they've got 100 mil net debt after the acquisitions they've made recently. That's 20 times interest cover. So I've got no concerns whatsoever with regard to their balance sheet.
And I'm a pretty simple guy. If I see a PE of 20, I sort of hope earnings per share growth is going to be close to that. Is that a very simplistic way that you would view PEs and earnings per share growth?
No. So that's a good way. So you're talking about your PE to growth ratio, and 1 is that number that people look for. So that's not simplistic at all, and I do bear that in mind, and I'd love to be buying this on a peg of 1, but obviously I'm not. Where I look to see the difference is what will the earnings, how comfortable am I with forecasting earnings 2, 3, 4 years out? This business is extremely steady in what it does. It is very predictable in what it does, and that's not to make it sound simple, but if you look at their track record, they can increase prices comfortably. They're managing their cost base comfortably. They have a lot of flex around their marketing. So you can, with some degree of comfort, look out 2, 3, 4 years and see where that number might be. So that's where I'm prepared to pay more than your value type multiple for this business.
And lastly, is it a case of just seeing those earnings and those earnings per share grow over the next 2, 3, 4 years, or is there something else out there that could potentially lead to a re-rating in the next 12 to 18 months?
Yeah, so I think there's a couple of things. Firstly is we get a lot of macro data, not from the company, but just macro data around listing volumes. So I think that will have an influence month to month. And as I mentioned, I think it will be better than the market is forecasting. They've also got their AGM coming up in November, I believe it is. So I'd look to see some type of update there. And then thirdly, in terms of any acquisitions, buybacks, anything like that, given they've done 2 material acquisitions in the last sort of 18 months or so, I don't expect anything material in the near term. So in that regard, just a consistency of ongoing earnings growth from the company.
Awesome, mate. It's a beauty. It's a great update, and thanks very much for coming back on and sharing it with us.
No worries. Thanks for having me.
Thanks, mate.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.